before we get into the aspects of cryptocurrencies, blockchain, I think we'd start with a bit of an understanding of the technology that comes out or that has emerged from the establishment of Bitcoin. So there's two essential sort of concepts here, centralized ledger and a distributed ledger. It's essentially a centralized system and a decentralized system. So the traditional system that a lot of people transact with is a centralized system. So what that essentially means, it means you have a centralized authority which is responsible for maintaining a set of records. So just to kind of simplify it a little bit down, when I say ledger, just think about a record. Think of a record book. It's a record book that has a list of transactions that are monitored. So in that centralized aspect, the best example I can pull on is a bank. A bank is responsible to monitor the transactions and the flow of money of people's funds, essentially. So if you're willing to, an example, for example, if I'm willing, or if I'd like to transfer some money to Craig, I'd have to go to that central authority, my bank, and essentially ask their bank to please transfer my funds to actually Craig. But they have the final say in terms of whether that actually occurs. They can restrict, they can deny that transaction. There are cases where they can freeze accounts. If we pull on, for example, what the ATO can do in terms of with your banks, they can issue garnishee orders to the bank to say, look, those are my funds, but please forward it to this actual, forward it to the actual ATO. So the point there is the underlying control doesn't sit with you, it actually sits with someone else. And all that information is essentially located in one area. So then we move on to the aspects of what a distributed ledger is, which will tie into what blockchain essentially is. But what a distributed ledger essentially is it's that record book, which is more or less retained by a number of participants within a larger network. So the way I can sort of provide an example of how this actually looks is, let's say we're all in this room. We're all in this room, everyone has a copy of that actual record book. It's not in a single location that we're sharing, everyone has a copy of that actual record book. In terms of how the transactions and how things are updated on that ledger, essentially, pulling on an example, if I was wanting to transfer funds from myself to Craig, I would then send that actual request with all the relevant details of sending said amount to this specific location to everyone out here. Everyone would be involved in terms of verifying essentially authorising the actual transaction, as well as making sure it's legitimate. You're essentially looking at the underlying records of your own books and ensuring that it actually all makes sense. Do I have the funds? Does Craig have the necessary details? Are the details within that transaction request actually all relevant? So it's a more or less a consensus approach to keeping those records. And once the majority or everyone in this room agrees that transaction's occurred and it's all checked out, everyone goes ahead, updates their own ledger. So to even simplify it one step further back, if I was going to pull out a $100 note and give it to Craig, it's effectively the same concept of if I had 100 people physically watch me give Craig $100, then you would obviously, or you clearly would either come to agreement, I've physically given Craig $100, you verified that I have in effect given him $100, and then you'd all come away in agreement going, fantastic, that occurred, and that's essentially the record. That's essentially the same approach a distributed ledger system takes. Moving on from that aspect, then we tie this into blockchain. So blockchain in the concept of Bitcoin is essentially a distributed ledger, but the key attribute that differentiates it is it's a publicly distributed ledger. So it means anyone here can view it, can access it, can transact with it. There's no central body. Everyone here can be involved in it. And it's essentially just a distributed ledger. There's some concepts and keywords of jargon I want to kind of elaborate upon in terms of what within blockchain itself. Some of those keywords you'll probably hear in nodes, blocks, miners. What essentially a node is. A node is the individuals within that actual network. So a node can be a participant in that network who's responsible for authorising transactions. A block essentially is, pulling back on that record keeping example, is essentially a line item. It's essentially a line of transactions. That is what a block is. The miners are essentially the individuals who are responsible for validating, updating, and processing those transactions. There is, in the actual example of Bitcoin, there is an incentive scheme of actually participating and validating transactions in the terms of fees and issuance of further Bitcoins. When you hear blockchain, it's a great word. Essentially, it's just a distributed ledger, which is public. So moving on from that, you can have different forms of distributed ledger. You can have a private, you can have a more tight-knit network. It doesn't have to be purely public, and that kind of rolls into the potential commercial application of this. When you have a larger network of businesses leveraging off the technology to actually benefit from some of the actual value propositions it proposes, which we'll go through a little bit later on. Any quick questions in relation to that before I move on, though? Then we move to cryptocurrency. So cryptocurrency refers to essentially Bitcoin, altcoins, coins. The term Bitcoin and coin, that's the first essential cryptocurrency that came about. Altcoins refers to anything that essentially superseded it. How an altcoin actually comes about, it can come in two essentially different ways. You can have its own essential native blockchain, or it can be established via a fork. So in terms of what an actual fork is, but I'll actually make comments in terms of what my description of what the blockchain is and the relationship it has with Bitcoin. It's a statement down there where it says, look, the Bitcoin blockchain is essentially just a distributed ledger which records the ownership and transfer of these coins within that actual ledger. It's a native asset. It's not tangible. You can't take it out. It's just a native asset of that actual blockchain. That fork component I was talking about earlier, that has that relevance to those altcoins. So when to actually understand what a fork is when we look at the blockchain, in Bitcoin's examples, we have a series of rules and protocols that all the nodes rely upon, the participants in it, in terms of how we authorize, how we validate, and how we update that ledger. If there's a divergence in those rules and protocols that they abide by to update that ledger, that is where a fork can occur. The key thing to note here is the data in the ledger itself, the information within it is retained. But from that point onwards, let's say we split this room down the middle and we change, this half goes, all right, well, from this day onward, we're going to process transactions in this certain way. There could be a variety of different reasons, essentially technical, one I won't go into for tonight's session, and that other half of the room will abide by a different set of rules. At that time, you'll have that divergence and you potentially have the creation of a separate altcoin. The most common forks you'll hear about are essentially hard forks. The most common examples, Bitcoin, Bitcoin Cash, Bitcoin Gold, Bitcoin Legacy, there's a whole bunch there. There's many others. But that's essentially what a fork is. There's a bit of a diagram down there that confirms what I've said earlier. This moves on to those value propositions I was referring to. So I think blockchain essentially, I've jumped it up to two value propositions. One's essentially record keeping and the other one's transaction setting. So what I mean by record keeping, the nature of that ledger, or being public in the Bitcoin example, since everyone has a copy of that ledger, makes it extremely hard to manipulate it and edit it. So if you're willing to, for example, if I have a different ledger, I want to put an extra zero on top of my Bitcoin balance, I send a transaction out to everyone else going, hey, look, I've got 10 Bitcoins instead of one. The consensus here will go, well, actually, my record says the complete opposite. I'm going to redirect that transaction. That's what we mean by record keeping. It's extremely hard to alter data in it. Transaction setting, that ties into settlement, the accuracy of settlements and the timeliness of settlements. So when you have a larger network actually responsible for updating that ledger, settlement of transactions can occur a lot more quicker. We're talking potentially a couple seconds to a couple minutes. So if I'm wanting to transfer a cryptocurrency, it essentially can happen within a couple minutes instead of the normal processing times when we refer to banks, which could be a couple days. In terms of what this means for the industry, there are a couple of commercial players looking into investing into the DLT space. A couple notable mentions are at the ASX. They're looking into it purely from a settlement approach. Settlement can occur a lot quicker. They're trying to converge all their separate databases of information into one, and it just succinks the whole entire thing. In terms of how it's implemented and whether the value that I propose up top is actually achieved, I don't know. It depends on how you implement it. The way you implement a distributed ledger will determine whether there's actually any benefit to it. There's also the CBA, which I think has got more legs to it, essentially. The core reason they're looking into DLT is between them and their subsidiaries, international subsidiaries. And the reason why they're doing that is they're trying to converge all their data into one. They're trying to have this distributed. Converge is actually not the right term. They're trying to share and distribute their information along their subsidiaries. So when there's international money transfers occurring, settlement can occur a lot quicker. There's more consistency. That leads on to, but before we leave on to how you purchase, any questions in relation to those sort of overall concepts? Fantastic. The question of how do we actually transact? How do we actually buy it? You've decided to buy it for whatever reason. Now, first step you probably need to do is talk to your advisor. And Craig will probably discuss why. The tax space in terms of how you transact with is very murky. Your intention may be one, your behaviour may be other, a completely different intention essentially, and the tax outcome can be completely unexpected. So that's the first piece of advice I can give you. You're looking at transacting, talk to your advisor. You're wanting to buy a Bitcoin, you essentially have to register for a wallet. So essentially what a wallet is it's a place where you're provided a public address and a private key which is stored within this wallet. What a public address is, in the concept of, let's say, the Bitcoin blockchain, it's essentially an address within that blockchain you can send and receive Bitcoin to. What your private key is essentially a digital signature. It's a password which authorises you to be able to transact with from that public address. So wallets come in many different forms. There's offline, there's online, there's cold storage, there's many other different types. They have all their different sort of characteristics. The most common one, when you, let's say, go to an exchange, which is a place you potentially can buy Bitcoin, they'll have an online wallet, which is essentially a wallet which provides you that public address and private key, which you can then potentially send funds into for them to actually transfer some Bitcoin from another intermediary in there. Once you've established the sort of wallet you want, which there's many different types, and we'll go into the characteristics of each a little bit later on, you essentially need to buy from that exchange, as I mentioned. But the thing that I would highly advise is when you look at transacting with exchanges, just be a little bit prudent in who you pick and who you actually use. I'm sure in the media you've heard many times that there's theft of Bitcoin, people steal it, there's hundreds of millions of dollars essentially being stolen from many individuals. We need to clarify, it's not essentially blockchain or the underlying technology that is being circumvented. It's the exchanges. It's these private keys which are being stolen from these online wallets, which then allow that theft. So moving on from that aspect of picking a reputable exchange, you essentially, I would advise to transfer that into a relevant wallet, depending on what your intention is. So if you're wanting to store, to potentially hopefully have some sort of increase in value that you can realise later on, you'd probably want to look at transferring that into a wallet which is not connected to the internet. It's essentially an app on a phone, where it can even be a QR code on a piece of paper that you put in your back wallet. So that's what you're willing to do with it, or what you're wanting to do with it, should determine where you actually transfer it. So that moves on to the next aspect of what can you actually do with it once you've actually acquired it. There's a couple of different options. There's some retail providers that support Bitcoin. You essentially have a wallet on your app. They provide you with that public address you transfer money to. You go ahead and essentially transfer that money to that public address, authorising it via a private key. Fantastic. There's other actual providers and intermediaries that allow transacting with a lot easier. A couple of them are the Living Room of Satoshi, which is essentially just a third intermediary that it allows the payment of any BPay bills here in Australia. So what they essentially do is you send Bitcoin, they convert it to fiat currency, and then they pay the BPay bill on your behalf. The way there's no fees involved, essentially they make their money out of the foreign exchange rates. The other more common one is BitPay. So BitPay is actually an interesting provider. That they provide a debit card, which you're able to then load up and convert your Bitcoin onto this debit card in the form of cash, and then that's accepted at any other retailer that accepts a Visa card. So there are some alternatives out there, but those are the most common that you may come across. So from an individual perspective, that's generally how it's done. Now, the question needs to be asked, what does this all actually mean for small businesses and businesses in general? So transacting with Bitcoin, there are some benefits to do so. The first one, there are lower processing fees, generally. Your normal processing fees are about 2 to 3% for credit cards or PayPal usage, while you may only be looking at 1%. You do have to take that with a grain of salt. There are some currencies out there where transaction fees can be awfully high when there's a high amount of volume through them, but generally, there are fewer fees. The other one is high transaction speeds. So this ties into the whole idea of quicker settlements. If you make a payment, it'll clear potentially within a couple seconds, a couple minutes. So third one is all transactions are final. So what that means is once someone's sent you Bitcoin or the cryptocurrency, there's no body you can go to and go, no, I don't want to make that payment. It is final. You can't go to, for example, a credit card company and go, I want to dispute that charge. I never made that charge. Or go to PayPal and go, actually, I want to charge back those funds. So what that means for small businesses, it does provide much better controls around your refund and return policies. The last one, more payment options, I think speaks for itself. You have more payment options, it potentially exposes you to a wider range of consumers. You've got to take the good with the bad, and now we get into the bad. So risks. High price volatility is the major one. The issue with price volatility is if you transact with it, if someone purchases via Bitcoin, by the time you convert that to fiat currency, if you're willing to do so, the price can move anywhere between the bounds of 2 to 3%. I'm not saying it always does, but flash crashes are not uncommon within the pricing of it. So for a small business, a 2-3% move in the price can eat into your margins of any product that you're selling quite extensively, but can add up. Having said that, it can move in your favour, don't get me wrong, but as business owners, you do want a bit of a surety around your margins, and this does provide a little bit of risk in relation to that. The second risk is it's unregulated. There's no regulation around it. In terms of we don't know where the government's been going, we don't know if the jurisdiction that you're transacting with is going to support the certain currency that you're paying. A good example is, in terms of the changing regulatory environment, we look over to Venezuela. They've actually formed their own, or issued essentially their own state-sponsored cryptocurrency called Petro, which is backed by oil. But then we look back to Bangladesh, where it's completely illegal to trade, transact with, and you have the authorities essentially locking people up. So that's the issue with the regulatory environment. The tax environment, of course, is another aspect. There is an answer there, but it could change depending on how cryptocurrencies evolves over time, what the adoption is. So just to elaborate upon the concept of, all right, well, let's say your business has choose to adopt that payment. How does that essentially look? So similar to your individual wallets, there are providers out there who issue a merchant wallet. There's a couple key characteristics of what a merchant wallet does, and these providers essentially allow a bolt into your POS system. You need to find that appropriate provider for yourself. But the key characteristic of certain merchant wallets is they allow and they automatically convert any Bitcoin into fiat currency instantaneously. There's still a bit of a time delay between it, but it does mitigate that high price volatility. Any questions in relation to small business? Yes. Sorry? So the gentleman's question is, how do you actually, and correct me if I'm wrong, how do you actually know where the ownership lies, who owns the account, who it's actually held by? Is that correct? When you register a merchant wallet, you actually register with a third party that they require some detail. They require, let's say, the company name that you're registered in, so that identity with them is retained there with that actual wallet. So they still track it, but in terms of registering it with other regulatory bodies, there's no requirement. That could change. There could be a reporting requirement for business in the future to go, if you have a wallet like this, we'd like to see it. You might need to declare it. That could occur in the future. But when you do register these merchant wallets, you actually need to declare essentially who the title is, who owns it. That's effectively how those systems work, because they still need their records. In their records, they need to know who owns the wallet and where it goes to. Does that answer your question?
Yeah, it does. You know, I've got double forms to how to pay for register. So you just any name down.
There are points of ID that you actually need to clarify with, so they're not going to issue to anyone. There's certain documentation that you do need to provide before they issue one. So it's not, you can't just go out and go on a merchant wallet. There is actually some identity checks you need to do. Perfect. Final slide, most important one, what should you do with it? Invest in it, adopt it, how do you profit from it? So that begs the question, should you be investing in it? The short answer is I don't know. I really don't. I've tried to find, the way I like to invest is I like to see what the underlying value is and see if I can see value in it. But price is determined by what this gentleman down here is willing to sell it for and what I'm willing to buy it for. So coming off that, the only way I can justify any sort of value is through utility. I think utility will drive value. If there's adoption, if there's actual utility for the coin, then naturally value I think will increase. That begs the question, which currency is going to be the predominant one? Is it going to be Bitcoin? Is it going to be a state-sponsored currency? I don't know. You need to make your own assessment on that. But I think the general concept of utility and value are very closely connected when you look at value on these coins. Whether the actual price right now is indicative of its actual utility, I don't know. The price is volatile and moves around 50, 60%, if not more. That's something you need to essentially assess for yourself. It's a completely speculative investment moment in my eyes. If you see future potential in terms of it being utilised and actually being adopted, then there's potential there for it. I think the interesting part is potentially the technology. There are a lot of commercial applications here. You do have to be a little bit careful. Those key phrases of blockchain and cryptocurrencies and Bitcoin, they're touted by, they're basically used as buzzwords for a lot of even listed ASX stocks. We're implementing blockchain. People immediately jump on that word and immediately think there's going to be some value in it. But the value of an actual blockchain really depends on how you implement it. So you've got to be careful. I think there is a promising future in the tech. Bitcoin and the blockchain is essentially, I think it's the first iteration. We might see it evolve, we might see it change. But I think there's potential value there as well. That's probably a little bit more tangible, but it's still really early days. Like the comparison is no one actually knows what the impact's going to be just yet. We refer back to the .com bubble. It's a very similar principle. No one actually knew what the rollout effect and what the impacts of the .com bubble were going to be. It's potentially similar to distributed ledgers. Yes, sir?
Is there a limited quantity of Bitcoin that is said why it fluctuates so high?
Yes, there is. So there's a limited amount of Bitcoin that can be issued. Once it's actually hit, that's it. So it's not going to be constant. So once that actual unit is fixed, price is going to determine what the value is. But that begs the question, it doesn't really matter what the actual fixed value is because you can transact in fractions of a percent or fractions of a Bitcoin. So essentially price will be the underlying factor. That does tie into the actual issue of how do miners get incentivized. Fees will kick in. Payment method, I think is the last thing I'd like to touch on. I think it's potentially a great opportunity for businesses to implement, but I think if you're a business to consumer, so in a business to consumer industry, I think there's more potential there than if you're a business to business. Business to consumer is usually done at the point of sale. You're essentially experiencing the benefits in terms of broadening and exposing yourself to a wider customer base. However, when you look at business to business, potentially there's no real reason just yet to explore it, but there could be potential in the future. And of course, anything related to it, I'd highly advise to speak to your advisor, speak to your accountant. And that will tie into essentially the taxing consequences of it, because record keeping is going to be a big aspect of how we actually declare certain increases and decreases in value. Your intention will determine what that actually is, and that will lead into Craig's section of this actual presentation, who will actually elaborate upon those concepts. Thank you so much.
So the tax side, I suppose being, working in tax most days, the thing that drives nearly any transaction is your intention. So why did you enter into a transaction, and did you actually do it? Is that what you ended up doing? So, and this is exactly the same. So did you buy the Bitcoin? Were you trading in it? So in terms of tax, the way I look at it is there's a bit of a spectrum, and one end you got income, one end you got capital, and somewhere in the middle it sort of transitions, and it's difficult to work out where that happens. So one end, you're a trader. So I'm sure people know what a share trader is. Someone who spends all day, every day, trading stocks. Might be shorting stocks, might be doing all sorts of interesting things. Quite a lot of sophistication, quite a lot of income invested into that process. Those people are earning income. Where you're making money, you'll be taxed dollar for dollar. Where you make a loss, potentially, depending on the circumstances, you might be able to offset those against other income that you might have. And also in that sort of situation, your thing that you're trading, whether it be Bitcoin or share trading or whatever else you're doing, that's your trading stock. So potentially on top of everything else, there may be some avenues where there's a bit of a downturn, you may be able to revalue and get a bit of a benefit from revaluing your stock downwards if that's what's happened. At the other end, you've got the capital end. So everyone knows what a rental property is, everyone knows what share investments are. You purchase it for a long-term hold, potentially to generate some sort of capital appreciation. Much the same can happen with cryptocurrency, and certainly the ATO have issued a number of rulings and private rulings to people in that respect. The private rulings are getting a bit old now, because I think at the time they weren't quite as aware that the popularity would happen that has occurred. But even so, there's certainly guidance out there to say, well, if I do hold my Bitcoin or any other cryptocurrency for more than 12 months and my intention was for a long-term hold, you might be able to get into things like your 50% discount, which might be helpful. And then somewhere in the middle is that changeover where you're not a trader, you're not investing millions of dollars in your entire week into doing this share trading stuff, but you're not sort of sitting there and just holding it for long-term capital appreciation. You're somewhere in the middle. So you might have some money. You've gotten into a bit of a pattern in terms of maybe each evening you'll hop onto your computer and spend a couple of hours sort of shifting between Ethereum and Ripple and Bitcoin and whatnot. But there's no real great sophistication, and there's certainly time investments, probably only maybe a couple of hours a night, if that. In that case, you're probably somewhere in the middle there. So the gains you make are probably on income. So profits be taxed one for one. Losses you might be able to offset against other things. But you're not in that share trading end. So what that means is you don't get into potentially revaluing your stock if there is a downturn at the end. But the thing that certainly amongst the online forums and whatnot that have been popping up have been around, but I only paid $5,000 for mine and now it's worth $100. What do I do with that? Is that tax-free? So some people have heard of this thing called a personal use asset. So a really easy example is a painting. So you buy a painting, chuck it up on your wall at home, cost you $5,000, but you bought it for your private use. And you find out in 10 years' time that painting is actually appreciated quite a lot in value. The painting has become quite famous. The artist has become quite famous. Might have passed away. Might have done any number of things. All of a sudden, your $5,000 investment is now worth $50 or $100 or some other number. You can then sell that asset tax-free because it's a private use asset. You bought it with the intention of private appreciation, and that's what you've done. You made a gain on it, but you've gotten lucky. Could have easily gone the other way. Can you do the same with cryptocurrency? Short answer is yes, but it comes back to the whole intention piece. So why did you buy it? So did you buy it to play computer games and buy contraband and whatever else you might have been doing with it? If that was the case and you could actually prove that was what you did with it and it just so happened to appreciate significantly in value, you're probably okay. But if you go back and say, well, no, I've done nothing with it, for example, that's a bit of a common example that we see where they just buy it and they just add to it. I'm just adding more and more to it. You probably don't have it for private use because you don't have any use for it. You don't have any demonstrated use of what you've used that for. So in terms of that personal use asset exemption, my advice would be don't necessarily rely on it without professional input. Does that kind of make sense to everybody? So in terms of where the tax office is at with all this sort of stuff, they're actually all over it. So I think there was a comment before about, how does the ATO know about this or what you're doing? So I guess the short answer to that is they don't necessarily have access to ownership. So everyone knows, but people should be aware that you get a public address where people can look and see all your transactions, but there's no way of proving, my, digit, the letters and numbers, which I know is mine, but if someone was to look it up, they wouldn't necessarily know it was mine unless I told them that was my account. So it's quite difficult at the moment for the ATO to know what everyone's doing, but I dare say it may just be a matter of time until, for example, they require that sort of information to be handed over in certain circumstances.
Sorry, Craig. And a good example there is because this is a common question that comes up. They're like, well, the nature of cryptocurrencies, you can't actually, there's no audit trail, there's no ownership. How are they going to know? There's key points of when you transact with it, there is a bit of identity that goes out, and those common places exchanges. When you sign up for an exchange, you do provide some information. So the common example of how they'd actually know, they'd subpoena an exchange, they'd get that information, they'd see there'd be some form of transaction coming. It could be even just following the cash coming out of an account, seeing it's been used to purchase something under an underlying name, that there are ways of tracking it. And it's not necessarily through the actual because you can't track it in the blockchain itself. It's when you transact with it that it leaves some form of trail. So you've got to be careful there, because I think it'll become an environment. Once there's value for the ATO to start looking, which it has already got to that point, they will look at avenues of collecting information. They've been renowned for it in terms of data matching. They do it for a variety of different assets. Why would they not do the same in terms of cryptocurrency? So you've got to be careful. And that's why record keeping is a big aspect of it. And don't rely upon, no one knows. Well, there's ways of finding out. So, sorry, Craig.
And we've actually been speaking to certainly at least one gentleman at the ATO who's in this task force, and he's a lot of what he said is very much in line with what we've just said a moment ago in terms of intention being key, behaviour being key. If you can prove both of those things, then you're probably on pretty firm ground. If there's a bit of a discrepancy between the two, the question becomes, was that really your intention in the first place?
Sorry, Craig. One other thing, in terms of, let's say there's different intentions. I'm not too sure if you're going to cover off on this. If you can have more than one holding and have different intentions with it, but record keeping is the biggest thing. And what I'd essentially potentially recommend is have more than one wallet. So if you want to purchase Bitcoin to personally transact with and potentially fall under that personal use exemption, obviously you'd need to go through the necessary steps through seeking your advisor, actually seeing whether that your facts of what you intend to do will fall under that exemption. But the crux of it is have a separate wallet that you potentially personally transact with, so you can isolate that from the rest of your holdings. There's nothing wrong with that. If you want to trade as well as hold for investment, as well as have for personal use purposes, have 3 separate wallets. It's much easier to prove intention and behaviour if you can isolate those.
All right, so Janos mentioned before a fork. If anyone's traded Bitcoin before, you'd know, for example, Bitcoin is forked a number of times. I think virtually all the forks have come off the Bitcoin blockchain. I think a question that was put to us before tonight was, what's the tax on forks? How does that all work? If anyone's owned shares in, for example, BHP, you'd be aware of such a thing as a demerger, where one thing becomes two. Our view, and certainly the feedback we've gotten from the ATO, is that it's similar to a demerger. So you have one coin becomes two, you then work out, I paid so much for that coin before it forked, I somehow have to split that value between those two coins. So it gets quite interesting depending on the nature of the altcoin that arise. Most altcoins just arrive and go nowhere. But there are certainly examples of ones that have become quite valuable. So ones like Bitcoin Cash, Bitcoin Gold, Bitcoin Legacy, etc. So thankfully, with things like tax returns, there's benefit of hindsight usually. So you might do a transaction today, but the tax return won't be done for a year's time. In that time, you better work out, well, was that going to go anywhere? There's a bit of a leeway there. But certainly that's the feedback we've gotten from the ATO in terms of that particular issue. So again, another question that was put to us before tonight was super funds. So lots of people have self-managed funds, and they're quite attracted to trying to load up the super funds as much as they can, where they can shelter profits of 15%, which is completely fair enough. So in terms of, can you invest in cryptocurrency in your super fund? The answer is you probably can, but should you? The answer is, well, talk to your advisor first. Certainly different people have different circumstances, so that needs to be taken into account. In terms of investing in your super fund, assuming that you've been through the process of, yes, it's a good idea, it suits my investment strategy, there's probably some things just to tick off before you move ahead. So first thing first is, Janos mentioned before about having wallets. If you are going to buy Bitcoin in your super fund, make sure your super fund has its own separate wallet. Don't set up a wallet in your own name. If you've got a self-managed fund, you understand the issue of separation of assets, so that's quite important. Next point being, don't put your own Bitcoin into your self-managed fund. So there are limitations around super funds can't acquire assets from members except for in very specific circumstances, and Bitcoin or cryptocurrency does not fit within those circumstances. So if you are going to invest in cryptocurrency in your super fund, go to an exchange and buy it from a third-party person. Next, investment strategy. So anyone who's got a self-managed fund knows that an investment strategy is a pretty important document. The nature of a cryptocurrency is quite unique, and if you have an investment strategy that deals mainly with traditional type of investments, it may not cover the nature of a cryptocurrency, so you may need to add in a separate asset class into your investment strategy to sign off on that being okay. And last but not least, read the deed and make sure that there's nothing in your deed that doesn't allow, or it's not that it would disallow it specifically, it doesn't specifically allow it. So some older deeds will have some rules written into there in terms of what sort of assets you can invest in. It can be quite traditional, so it might be shares, property, cash, but it may not specifically mention something in the nature of cryptocurrency, which isn't any of those things. So you may need to amend your deed to make sure that it lets you do it. So moving on, so in terms of what's next, so the interesting thing with cryptocurrency is just the nature of it from a tax perspective, and even in terms of different aspects of tax. It's quite curious in terms of the tax treatment from a GST perspective is completely different to the treatment from an income tax perspective. Until recently, I think from 1 July 17, cryptocurrency was basically treated as barter. So if you were transacting with cryptocurrency from a GST perspective, you were given to have been swapping items, you weren't actually purchasing with currency, which actually created a bit of a GST issue because it basically meant that you're effectively losing in input tax credits that you were otherwise entitled to under normal GST rules. Thankfully, from 1 July 17, they've changed those rules. So from 1 July 17, purchases with Bitcoin will now be able to claim your GST input tax credits as you normally would. But we still have the income tax side to deal with. And so we have this issue of, it's a little bit like stock, it's a bit like shares, a bit like, I actually think it's a bit like a junior miner. It's a bit of a flip of a coin, it might do pretty well, it might not. But the tax treatment is sort of like that in terms of it's not currency. It doesn't, in terms of the legislation, it doesn't fit within the definition of a foreign currency, because to be a foreign currency, it needs to be backed by a foreign government. So potentially the only foreign currency that might exist in this space might be those Venezuelan petro coins. Everything else is not foreign currency. So in terms of how does that treat from an income tax perspective, we're into that. Is it income? Is it somewhere in between? Or is it capital? But where we think it may go over time is it may just be legislated to be foreign currency, which potentially might make things a bit easier, a bit clearer. But for the poor taxpayer, probably make things a little bit worse as well. So foreign currency, in case people weren't aware, profits in foreign currency are income, irrespective of your intention, irrespective of use, irrespective of anything else, except for a very small number of exemptions. If you trade in foreign currency, if you went on holidays overseas and you converted it to US dollars and you came back and changed it to AUD on the way back and you made some money, that's income. That's just how it is. Those carve-outs don't necessarily exist. So we think that potentially might be somewhere they might go, but obviously watch this space. So I might just pass over to Janos for this one, but we were talking this morning about, certainly the main drawback we see with cryptocurrency is the volatility. Why would you transact in something where 2 hours later it might be worth significantly less than what you were paid for? And what ways can that be potentially overcome? And we've found that some providers are providing some solutions to that volatility.